Hello and welcome. In this video we're going to discuss Dow Theory. Now, Dow Theory was created by Charles Dow many moons ago. The basic premise of Dow Theory is that there essentially is three stages to an uptrend, a bullish trend, and three stages to a bearish trend, a downward trend. And by knowing and understanding what each stage is and how that means in terms of both the chart you're looking at, how you would possibly trade that, and what fundamentally it means to you at that time, say that particular stage is at, allows you to gauge a trend much better than many other means and tools out there. But it really is pretty much the grandfather of analysis in terms of first analyzing the trend. And once you begin to spot them, because they work both long and short term, as we'll show you, you'll be able to see that spotting trends is not actually that difficult. And in some respects, technical analysis is really not that difficult. Once you, like any other skill, get an eye for it, once you understand how analysis works, once you understand the tools and techniques and so on. But once you understand that and start to look and apply these tools and techniques, Dow Theory being one of them, of course, when you're looking for trends, it's always a great idea to understand them in the first place, but then you almost automatically begin to see them in every chart. And I'm not just talking about Dow Theory here, but in terms of any form of technical analysis, that you begin, because you absorb it and you sort of live and breathe it almost, that once you start to look at a chart, you pretty much understand what's a good chart and what's not a good one. Almost instantly looking at it, you can read it, almost like a huge sign that pops up. You can tell pretty much whether it's worthwhile or not. The other thing I want to point out is that Dow Theory has nothing to do with the Dow Jones Industrial Average, okay? We're just looking at the Dow Jones simply as a means of, it's one that does trend very well, it's one that moves a great deal, but you can apply the Dow Theory to any chart. It doesn't matter what the chart is. As long as that chart is trending, then you can apply the Dow Theory to it. So don't make the assumption that the Dow Theory only works with the Dow Jones Industrial Average. It's just a chart, it's just an index that shares the Dow name. So then, what is the Dow Theory? Well, what Charles Dow noticed was that there were three stages to a trend, whether that's up or down. And these three stages, which I'll explain in a short moment, basically show the underlying psychology that's going on within the growth or the decline of that particular chart. And by understanding where that, or what stage that chart is at, or that trend is at, you can pretty much gauge whether you're coming to the end of a trend, or whether you're at the beginning of a trend, or whether you're pretty much somewhere at the largest point, which is in the middle, stage 2, and that applies to both bullish and bearish trends. So what are three stages? Well, we'll look at bullish trends. The reverse is obviously true for bearish ones, so we'll also look at those too. But we'll first cover a bullish trend. So here we have the Dow Jones Industrial Average covering the last 12 or so years, and actually, sorry, 15, I just noticed it's actually 15 years, coming on for 16 years. And the great thing with Dow Theory is that it can cover any time frame. So for instance, we can look at the Dow in terms of the overall chart. You know, we could, in a broader way, we could possibly even apply it to the whole chart that we have right now, although that's quite difficult. But what we'll do is we'll show it just over a few years, how some say a fundamental trader would possibly sometimes, if they were using technical analysis, some do sometimes sort of lean towards Dow theory, and we'll just quickly show you why that is and the benefits of that. So if we highlight this period here, now I'm just using simple end of day just basic plot, so you can see for yourself how it grows. Now, one of the things you have to understand is that the trends don't constantly move in one direction. There is, with a trend, there are minor trends within that, and there's swings and so on. So you have to understand that trends are just showing the general direction of the growth of that particular chart. It's not going to constantly go up in one direction. There are going to be peaks and troughs as it goes along. So the first thing that we have with a trend is what's basically called the accumulation. This is a bullish trend. Now the accumulation is where we start to see those that are really in the know get on board a particular stock. It can be anything. It can be the Dow, but usually sometimes it's more often companies and so on that the accumulation phase is more pronounced. And the accumulation phase is relatively short, and basically it's like an initial spurt of bullish trading. And if we look at the Dow here, we do have an initial stage before it sort of consolidates a bit. Now consolidation is a period of ranged movement. Ranged movement, just very quickly so you understand, is a range between, I'm just doing this very roughly, between 2 points. So that first stage is what I would call the accumulation, or what they call the accumulation. It's the first stage. It's phase one within a bullish trend. So basically, all the real clever money, those that really have their fingers on the pulse, they probably have a fair degree of inside knowledge. The predominant movement with these are those that are sort of closest, that directly monitor that particular sector. So they would really have a real understanding that that's a possible move within that. So we have phase one within this bullish trend, and this bullish trend isn't a fantastic one, but I didn't want to pick one that was so blatantly obvious. I just wanted to show you one that was probably a bit more, that you'd maybe even ignore. So that's stage one. So that's where all the really very, very clever money comes in. The next stage is the phase two, or stage two, which is basically the main part of the trend, and we could almost say that would be from sort of here to here, and that would be the main part. That's where most people that are traders would get in. That's where the majority of your money would be made. How do you know you're moving from one stage to the other? Well, there tends to be a period of consolidation. Now you could include that consolidation as part of that trend, much like we could include phase one as having that consolidation there. But as soon as we start to get that consolidation, that's when you start to realize that that part of that phase or that stage is coming to an end. And you can basically measure them by the speed of their growth. So initially quite strong, then very strong, and then strong period of consolidation. But that's where predominantly we're getting most of the growth, is within this stage, the second stage. And again, I hasten to add, this isn't the clearest of trends that I'm pointing out here, and again, the reason being is that sometimes trends aren't that obvious. You know, if they were that obvious and it was that easy to make money, then everyone would be doing it. So I just wanted to choose a chart that was possibly a little bit more or less obvious. So we have the second stage, and I'm just drawing lines straight through. I'm not sort of drawing them where at the bottom of the trend and sort of hitting all the troughs or at the peaks. I'm just drawing the points where they appear. So this is where most traders would be getting in. This is where most of the action would be happening. This is the longest and most profitable part of the trend. And then what happens is we have stage 3. And this is where we start to have the excess of the trend happening. It does climb again a bit, but this is where you start to hear somebody in a pub telling you about how wonderful this particular stock or index is, how amazing it is. The reason being is that those that are in already have made predominantly most of their money already. The ones that came in at phase 1 are certainly very happy with their current result, which is anywhere around about here. A lot of them at this point would have possibly part closed at this point anyway, towards the end of stage 2, understanding that stage 3 is a shorter spurt. It's almost similar in length sometimes to stage 1. And what you get, it's where, say, the general public get involved. It's the consumer part of the buying phase. And it's also the toughest. Admittedly, it's quite a strong phase 3 there. But what you normally see is a dramatic drop, much like we saw before. And that's where a lot of the money starts to pile out. As soon as you see a beginning of a fall, most of the people in phase 1 have come out pretty much at the end of stage 2. The majority of the investment move from stage 2 will come out at stage 3 towards the end as soon as it starts to drop. And then at the end of stage 3, unfortunately, those that get involved at stage 3 tend to get burnt because the majority of the stock move is dictated by those that are investing in phase 1, the very, very clever money, and stage 2, the majority of the trading market. So those in stage 3 that are investing, that are hearing it from their taxi driver who said, you know, this is great, you should get involved in this, seeing it grow, it's going to go up and up and up. Or Joe down the pub who's seen this stock and he wants you to, you know, have a look at it and look how fast it's going up. As soon as it collapses a little bit, as soon as it maybe even reaches a point of resistance 2, which is another signal, then we're going to see a drop. And that's when the clever money starts to come out, and that's where most of the trading market starts to come out too. This, as I've said, phase 1 tends to predominantly come out towards, or starts to sell towards at the end of phase 2. Phase 2, those that get involved there will most definitely sell at the first sign of weakness at phase 3. Those that are in phase 3 unfortunately get hurt the most, because that's when the majority of the stock is sold, or majority of the market is moved and going short, and unfortunately they're still trying to eke some profit out and usually get burnt very quickly because the fall, as we can see, is quite dramatic. So that's the bullish part of a Dow theory. Phase 1 or stage 1, phase 2, stage 2, and then stage 3 where everyone else gets involved, and then the market begins to collapse. In the next video we're going to be looking at the reverse of that, and then the reverse of the psychology of that, but we'll also reference that in terms of looking back on the bullish phase as well, so you can see how the two combine together. So don't forget to watch for part 2 of the Dow theory, which will cover bearish trends. Thank you.